Hey, party people, welcome to this month's investment and property market update for July 2022. And it's been a pretty big month. A lot of people thinking about their money. Obviously, interest rates increasing, the inflation crisis in Australia, talk of an economic slowdown, a lot of noise out there. So I wanted to unpack some of the data and things that you should be thinking about to make sure that you're making the right money moves for you. So guys, look, before I jump into the content, please don't rush out and make any life-changing decisions off the back of what I cover. I strongly suggest you seek out personalized advice from someone with a magnificent beard before jumping in. So just starting with markets and in the news in particular, we're seeing inflation is high, but it's the growth rate at least seems to be slowing in Australia. Slightly different story globally and in the US in particular, but over here we're seeing some of the external pressures on inflation, specifically the Russia war on Ukraine, that has been impacting manufacturing costs, freight costs, and energy prices, that it's starting to ease. We're seeing the cost of oil come right down. The petrol cost has come off on wholesale markets, although not quite passed through the Bowser at this point. But, here's to hoping it comes through soon. That's dropped down 40 cents a litre, or 44 cents at the market, 40 cents at the wholesale market, 19 cents at the Bowser. So, that's a conversation for another day. But those things have been big drivers of inflation. And with those starting to ease, inflation is still going up, but it's going up at a slower pace, which is good to see and good news for mortgage holders. But the bad news for mortgage holders is rates are up. We've just seen the RBA come out, another 0.5% rate rise in August. That brings total rate rise to 1.75%, means $770 on an $800,000 mortgage, which is slightly below the average mortgage size in New South Wales. On $1 million mortgage, you're looking at about $1,000 a month in total extra payments since these rate rises have commenced. And it's the fastest rate of increase for mortgage interest rates, or for the RBA's cash rate, and by consequence the mortgage interest rates, in about 3 decades. So really rapid acceleration there, and tipped to increase further. Although some welcome news that they are now starting to talk of slowing down the growth potentially next month. It seems fairly likely, or the markets are pricing in another rise, but starting to get some doubt as to whether that will be a supersized 0.5% rise, or just a regular 0.25% that the RBA has historically followed. So time will tell on that one. But one of the things that sort of the flow-on effect from these higher rates is we've seen that fixed rates are now, like, for the people that have fixed mortgage interest rates that have them coming off in the next year, they're going to see increase to their cost of mortgage of around 40% in their mortgage payments. So it's a pretty substantial jump there. And I suppose people need to be steeling themselves now, but it is going to be challenging for a lot of people. And there may be some people that really struggle and have to look at options like offloading properties in order to make that work. But for anyone that does have a fixed rate that's coming off, the easiest time to prepare for that is right now. So, get rock solid on your budget, make sure you know what your plan of attack is, because you're going to have to do something at some point. So best to prepare now rather than waiting till it's forced on you. Another really interesting thing that I was seeing in the news is the potential for negative inflation next year. I mentioned earlier that some of those external pressures had started easing on the inflation, and the rate of growth coming down on that. If we end up in a situation with negative inflation, it means that the RBA is going to be looking closely at dropping rates quickly to adjust and get things back on track. It's not the end of the world if there is a negative inflation in the shorter term, particularly in light of the strong inflation that we've seen. But given that negative inflation risk is there, I was looking at something in the AFR over the weekend on this, that potentially what that means is that the rates will start dropping faster than people are expecting. If that happens, then the property market is likely to recover more quickly, share market recover more quickly, or grow faster more quickly as well. So some really positive signs for investors there, in my view. We're seeing the research coming out. There's some data released from SQM Research showing that the worst property market conditions conditions for selling in the property market for years are likely to be faced in spring of this year. So that's essentially over the next 3 months from today. And what that means on the flip side, excuse me, is that we've got the best buying conditions that we've seen in the property market in recent years, where we've got a lot of supply, less people in the market. So if property's on the roadmap for you, I reckon it's a great time to start looking at picking up a bargain. Now, one big driver of this, one of the data points that they were looking at, is the number of properties that have been on the market for longer than 6 months. And that number is ticking up. And with more properties coming into the market and the properties that are on the market staying there for longer, it means that there's more choice. What it also means is that for anyone that's selling a property, they know that it's going to be in their interest to sell their property ASAP today, rather than waiting another month or couple of months where prices are likely to go down a little bit further, meaning that they're going to be more flexible and potentially compromise a little bit more on pricing. So, talked to a lot of people over the last little bit that really struggling with hitting their property goals, and with the rate of increase in the property market over the last little bit. So if that's something that's on the radar for you, I would suggest getting your plan in place, making sure you're rock solid. Really important to have risk management in place with what's going on in the world and markets at the moment. But as I say, best buying conditions in years coming up. And yeah, look, I think that the share market is collectively holding its breath on what happens with the economy off the back of these interest rate increases and inflation data. We saw and I'll get into the market stats in a sec, but last month the share market, both in Australia and around the world, ticked up pretty strongly. But that we do still just have this potential for recession. The US has essentially entered what was the technical definition of recession, with 2 quarters of negative economic growth. Then they've sort of changed what the definition is, but I suppose that's another conversation. But if economic growth is slow for longer, it's going to be hard for the share market, for the companies to keep making profits, and that's going to drag on the performance of the share market. So watching closely what happens there to see how quickly things come along. Looking at the market numbers and what's actually happened, firstly with property markets. So Sydney property market saw a 2.1% decline last month. That follows a 1.5% decline the previous month. Melbourne down 1.4% off the back of a 1% decline in June. Brisbane down 0.9%. That's the first time Brisbane's dipped into negative territory for a few years. And in this current cycle, that's off the back of 0.2% growth in the previous month. Adelaide and Perth have both posted growth of 0.2%. But that comes off the back of Adelaide having 1.3% growth in the previous month, Perth 0.3% growth in the previous month. So the combined total of Australian 5 capital cities is down 1.4% off the back of a 0.8% decline last month. So we see that, Sydney and Melbourne started leading the decline with slowing of the property market just a few months back. Brisbane, Adelaide, Perth have been holding on to positive gains month on month. Now it has gone negative in Brisbane, Adelaide and Perth, and negative. It's probably likely that we'll see a bit of a dip potentially next month or in the very short term in those markets as well. Putting it in perspective, and obviously there's a lot of headlines out there and a lot of fear, but a 1.4% decline, which is the average decline in Australia across these 5 capital cities on a $1 million property, that's a decline in value of about $14,000. So not nothing, and it's always bad to see, not comfortable to see things going backwards. But off the back of a 23.7% gain on property last year, where things are still way ahead, and it's probably not the doomsday scenario that a lot of media commentators are talking about out there today. Looking at markets now, so the Australian share market first, the ASX 200 posted a gain of 6.3% last month. That brings the total performance for this year to 9.4% down in the ASX 200. S&P 500, so that's the 500 largest companies in America, went up by 9.11%. That brings their gain, their performance. They've posted a loss of 14% for the current year to date, calendar year to date, which brings them back out of the bear market territory, which is showing a negative 20% decline. The NASDAQ posted a gain of 12.35%, so really strong performance in the tech sector, but still they're posting a loss of 21.75% for the year to date. And the crypto mega cap index posted a gain of 31% last month, which look, it's still down 51% for the year to date, but it's a pretty strong turnaround in that market. And there's a lot of talk of the crypto bottom being met there as well. So overall in equities, definitely some positive news there for investors. Good to see that recovery in place. And, you know, it sort of highlights the fact that things do move pretty quickly there, with a lot of people paralyzed by the fear, wanting to sit on the sidelines, wait and see. And often when you do that, you're sort of missing the boat. Our investment story of the month is Prosper Group, which is PGL on the ASX. They're Australia's #1 small biz lender. They just did a record quarter of lending, doing $104 million in new loans, and their share price is up 21% year to date. Now, I find that those sort of companies, the lenders, and MoneyMe is another one of those, that they tend to perform really well, almost regardless of what's going on in the market conditions. Obviously, a recession bad for business, but I think this is definitely one to watch over the next little while. In terms of what to look out for in markets, inflation is really crucial. That data coming through, how quickly it slows, what happens there, what the economy does as a result, and what unemployment does in particular. Because I think if unemployment can stay at anywhere close to the record lows that we're seeing at the moment, that's going to say good things for the economy, keep the economy sort of ticking along, and that does good things for investment markets. We're seeing property buyers pretty fearful out there at the moment. Aussies love property, and there's always so much talk of this property market collapse that just doesn't seem to come for some reason. So, I say that sort of tongue in cheek for someone that can't read through my monotone intonation there, but we do have really strong fundamentals of the Australian property market: strong demand, net population growth, low unemployment, areas, limited supply, restrictions around that. So, I think that it's something that's really gets a lot of attention and a lot of clicks and drives a lot of advertising dollars for media, but some of that fear is a little unfounded, in my opinion. Interest rates are increasing, but potentially starting to slow. So next month will be really interesting. That up until the last board meeting, they were predicting a 0.5% rate rise this month, 0.5% rate rise next month. Now talking about potentially 0.25% next month. If that happens, I think it'll be a welcome sign for the economy and signal that the RBA is confident that inflation is coming down. If it's 0.5%, I think we've still got a ways to go with the cash rate at 1.85%. Even the most sort of rosy of forecasts have the cash rate capping out at 2.6%, and most of them have it capping out just over 3%. So it seems that they're still going up there, but if it's going slower, that's going to be welcome news for borrowers and also the economy and investors as well. And I think the potential for a sharp recovery there based on that, both in economics, property market, and flowing through to the share market as well. Something to really watch again with the inflation data and what happens off the back of that as well. So getting into the nitty gritty of the Australian economic data. So our inflation is up at 6%. That's from 5.1% last month. Household savings rate, the data hasn't fully been released for the quarter so far, but I was just looking at some data the other day that showed that through the last 2 months, Australian households saved a total of $5 billion, which sounds like a big number. But in the previous 2 months before that, Australian households saved $25 billion. So basically, the household savings rate has gone down by 80% over that period. And I think that shows that people are either, struggling with higher costs, that's chewing up part of the savings. But yeah, it's an interesting one to see when households are pulling back that much. It's clearly there's something going on. They said it could be potentially a seasonal trend, so the next couple of months I think will be interesting to see. But clearly a big turnaround there. Economic growth is still steady. New data hasn't been released, as well as unemployment growth, unemployment rate, and employment growth. The Australian dollar is currently buying 70 US cents. That's down from 71 US cents last month. In terms of the US economic data, they are running this record inflation at the moment at 9.1%. That's increased from 6.3% in the previous period. GDP growth is down 0.9%. That's following on from a decline of 1.6% in the previous quarter. And as I said, that meets the technical definition of a recession. Their unemployment rate's steady. Household savings rate is declining slightly, 5.1% from 5.4% in the previous period. And home sales are down 11% in the last period, although property values over the 12 months there, reading between those lines, is still up 20%. So it does point to a slowdown in the property market there, but it's similar to the Australian story. It's off the back of a period of really strong growth. Now, looking at some of the trends that we're seeing at the moment, a big one that we do a lot of work with tech professionals, and they have employer share plans or employer share schemes, ESS, and we're seeing a lot of people that have been really punished for not having any plan or not having a clear plan around what they're doing with their shares. Basically, when employer shares are granted, that there's a tax obligation that's created. And when markets are going up, it's all gravy, because if you ever need money, you can sell your shares, you sell them at a gain and no worries. But when markets are going down, the tax bills keep coming in. And sometimes, and we've spoken to a number of people that have shares that are worth less than the tax bills that are there, which means that you've actually lost money as a result of being given a bunch of shares, which is not a good position to be in. It really highlights the importance of having a crystal clear plan around that and making sure that you're protected so you don't get caught short. Super, super painful one. And it's often not big. It's often not small numbers that we're talking about. So for any tech workers or people with employer share plans, make sure that you're on top of your strategy and dotting your I's and crossing your T's, prepared for a period of turbulence over the next little bit. Crypto recovering, well, it's bounced up considerably, but it's recovering quite slowly from the dip. A little bit more interest out there. There's a lot of noise out there in the crypto space as well, but we are seeing that recovery. And importantly, it seems to be tracking fairly in a reasonably stable sort of way, at least up until last month. We were still seeing big downs and a lot of fear out there and worry that there potentially might be further shocks that could push the crypto market into more trouble. Shares were up strongly in July, as I mentioned. So yeah, good to see that growth happening. A little bit of recovery from people who copped a bit of a hit in previous months. And another thing that I'm seeing at the moment and getting a few questions from people on is that fixed rates are incredibly expensive at the moment. We're seeing most fixed rates at around the 5% mark, which, given the potential for a fairly quick recovery in interest rates, to me that seems expensive. Now, it depends on your circumstances and where you're at with your money, because for some people, fixed rates, the certainty that they provide, are really important. But just looking at the cost, you just want to make sure that stacks up for you. So it's starting to increasingly be not stack up for a lot of people in my view. So just be careful if you're jumping into that path. And the other trend that we're seeing is that there's a lot of fear of people that have purchased properties over the last little bit. Now, anyone that's bought properties in the last 6 months in particular has probably seen a bit of an on-paper loss there. And it's never good when you see that when you're, with investing into anything. But I was actually just comment on TikTok today that saying I was going to buy a property 6 months ago. I'm so glad I did it. And I said, well, I bet anyone that did is sort of regretting it today, but I bet 10 years from now they won't be. And I think that that does really hold, that short term is short term, but these are long term investments. So keep that in mind, and you're going to alleviate a bit of your stress levels as well. In terms of our hacks and mistakes, starting with the client story of the month, working recently with a couple in their 30s, their combined income 320K, their assets and investments was total of 560,000, and they were saving a total of 5,000 per annum. They had some pretty big goals, but no real direction to get there. They were incredibly frustrated by their tax bills. These guys ran a small business, and they had no pathway to their dream home. What they wanted was a clear strategy to get a nice roof over their heads that they were happy with, that they owned, and a passive income from investments, so that they love working but didn't feel like that they had to do that. Now, what we chose to do as a result of the plan was purchase an investment property with a view to buying another investment property when the numbers stacked up. Clear tax plan. We did a little bit of restructuring, which saved a considerable amount of tax with how they were running. It just basically had the wrong entity structure, and then doing some regular share investing. With the benefits for them, clear pathway to their goals, and the financial outcomes of that plan was a benefit of $13,000 in year one, and over 20 years, $3 million worth of projected upside there just from the changes made in the first year. And that's after all financial advice fees as well. So yeah, a really good story, and I suppose highlights the benefits of clarity, but also just having things structured in the best way possible, particularly for small business owners. That's a really big one. Our client problem of the month, following on from what I was saying with ESS tax bill, we've actually had more than one of these, but someone with employee share scheme tax bill higher than their share value. Real hassle to get out of it. And basically there's no flexibility in the tax law such that you need to really scramble to figure out what to do. Don't let that be you if you've got an employer share plan in place, because it is a big headache and sort of really can hamper you and slow down your wealth building. Our mistake of the month is buying into MediaFear. We had this client, really lovely. She is a little bit older and had a few more defensive investments in her portfolio, so bonds and those sorts of investments. Got into reading as you do. She's interested in educating herself about money, but then reading some of the commentary about bond markets and share markets, and basically just got herself into such a spin that was ready to pretty much sell everything, which would have been a real disaster with where the markets were at. And it just reminded me that how easy it is to buy into that hype, particularly like we even talking to someone that's got a financial advisor in place and they're almost doing that stuff. I just think what happens if you don't have a good support or sounding board or someone to talk you off the ledge, really, really valuable in the current market conditions just to stop things doing better. A lot of research that shows that making the right decisions around timing or avoiding making the wrong decisions adds up to about 3% annual return year on year, which makes a huge difference, particularly if you're young and you've got a lot of years ahead of you from an investing journey perspective. Our money hack of the month was minimizing first home spend. This is for a client, and we work with a range of clients. This one in particular, though, she's making a good income and saving a bit, but not heaps, not like falling over piles of money or anything like that. And looking at buying her first home, and we were looking at how much to spend and what sort of property she would be happy with. And then anyway, she ended up compromising a bit on. She found a property that was $100,000 less than she was initially going to spend, and figured that she was going to be happy with that as a stepping stone property, at least for now, until she'd hit some of the wealth targets. And what we realized was, as a result of spending less, it meant less money going in as a deposit, less money from a cash flow perspective on the mortgage payments, less ongoing costs because the property was smaller as well, which left a lot more money for wealth building. And it made a massive difference in her bottom line over the years to come. So I get that it's nice to have a nice roof over your head, but when you minimize how much you spend on your home, you maximize how much you can spend on building your wealth or invest into building your wealth. And it does make a pretty considerable difference. And our success story of the month is we've had a couple of these that first property purchases after putting in years of work with market conditions, turning in property buyers' favor. After they hadn't been for the last little bit, we've had a handful of clients that have bought their first place after saving for a bunch of time to get there. So it's it's hard going, particularly if you don't have family support and you're looking to save up the property deposit all on your own, and you don't want to take out a massive mortgage. So it's highlights to me the benefit of just keeping your focus, knowing what it is that you're doing. And I found that these people have followed the bouncing ball because they could see that it was all achievable. When you got massive goals, if you don't have a clear target, it's much, much harder to follow the path. So guys, that's it from me for this month. If you've enjoyed this, please give it a share around to anyone that you think would like to make smarter money decisions. And guys, I will catch you next time. Bye for now.